Yeah, thank you for having me. Good afternoon, everyone. So, as well as said it, I work in the industry. I work in the design, that is, in the research and the development of equities, quant equity strategies. So this is going to be a very different talk from the previous one. Absolutely non-technical. And Pascal said it, in parallel, I teach quantitative portfolio management at ETH in the University of Zurich. As you can see, the title of today's talk is Quant as a Service, Active Investment Solutions at Passive Costs. And I would just like to start with a statement. So in today's investment landscape, it is far more common to find passive strategies priced like active ones than active strategies priced like passive. What did I want to say? Than active strategies priced like passive ones. Yeah, sorry. So probably you will find some exception, but I would argue overall the pattern holds, at least in Switzerland. In Europe, regulators have taken note of this issue and are starting to take measures so that investment managers price their products aligned with the underlying strategies. Probably in Switzerland, the regulator will follow, but we're definitely not there yet. So over the course of the next minutes, I want to explore this issue a bit, ask some questions. Why does this imbalance exist? How do investors respond to it? And what does it take for a paradigm shift? To do so, I have prepared three chapters. In the first part, we would look at the market landscape as it is today, which is framed by this divide of active and passive. Then I would claim in the second part that we are witnessing a shift in paradigm right now, which increasingly renders this distinction between active and passive obsolete. And then, depending on time, I would briefly touch upon some technical details, the devil's in the details when it comes to the construction of factor strategies. All right, let's begin with a little history. Our industry has long been shaped by by the ongoing debate between active and passive. And at the heart of this discussion is, of course, the question of performance. And it is indeed this question whether active managers possess genuine skill that sparked the idea of having a passive product. At the time, however, the vocabulary used was not active and passive, it was managed and unmanaged. And it was in an article of the Financial Analyst Journal in 1960 by Renshaw and Feldstein, where they made the case for an unmanaged investment company, with the idea that you would have a fund that just tracks some standard index like the Dow Jones. And they argued that most investors would be content would be happy with the performance of such an index because anyways, managed products generally underperform these standard indices. So they claim. And it is not without irony that initial objection came from none other than John Bogle, who in that same year in the same journal published a case for mutual fund management. If the name John Bogle doesn't ring a bell, Mr. Bogle later on founded Vanguard, which today is the world's largest provider of index products. So quite a change of heart he had, but a very lucrative one. If you look at the evolution of passive products compared to active ones, this is a chart taken from a study by Chris Reitman from Research Affiliates and Campbell Harvey. And it shows the proportion of active and passive products in the US, starting in '93, which is actually the year where the first index ETF was launched. And you see that today, passive surpasses active management. If you look at fund flows, as for instance published by ICI Factbook, we see that most of the money from active products went into passive ETFs. Notable here is also this little orange part, which is some niche products that are emerging, which are active ETFs. This is certainly something to keep in mind, but overall, I think one has to acknowledge the remarkable success of passive products. So in this race between active and passive, passive is the clear winner. That is, even though we all know passive is not without problems. One major concern is that of concentration risk. So what you see here is an example of the MSCI World Index this summer. You see that the top 5 companies make up 1/5 of the entire index. And the just 5 countries make up nearly 90% of the total weight. The top position, NVIDIA, at the weight of 5%, 5.7%, is twice as large as all the Swiss companies in the index.
So supposing I sell continuously monthly Markowitz rebalanced product, is that passive or active?
Continuously rebalanced?
Yeah, because, you know, every month we do a rebalancing on Markowitz formula already pre-specified. Everything is just going to follow a formula through time. Yeah. But it's always being rebalanced, and there's no active intelligence of the rebalancing because it's a formula.
Yeah. So it's a good point. I didn't put the definition of what is active and passive, and I think there are 2 camps in industry. People would say passive is everything that tracks an index. The strict definition, so that's more in the sense of unmanaged. There is no. But I would say the strict academic definition is it's just the average of every investor. That's how Sharpe defines it. It's just share price times the number of stocks in the market. It's the average. Yeah. So back to these concentrations, you see this NVIDIA, this large position of NVIDIA, larger than all Swiss companies, actually larger than any company in any other market, even all the Japanese companies. And you don't see it here, but it's also larger than the entire energy and real estate sector combined. So these are really impressive numbers, and they do pose a concern for many investors. On the other hand, passive investing comes with clear benefits. I've listed a couple of them here. So you have things like it's liquid, it's low cost, it's transparent, and there's ease of investment. And, well, diversification, that is debatable. Another point is that, which is maybe obvious, but still very important, is that there is no deviation risk. If you which is often the case, if you are measured against a cap-weighted benchmark, then investing in a passive product means you don't really have to justify your performance. You're always tracking this. And so when your strategy loses because the market crashes, you can say, well, it's the market, what can you do? And if things go well, no one asks any question anyway. So where's the incentive to deviate, right? I mean, I'm exaggerating a bit, but there is some truth to that, in that I would say among all the dimensions of risk, this perception of risk as underperforming is a very dominant one, at least in the institutional world. But said that, I think overall these passive products have served, at least historically, a very useful economic role, which is to give low-cost access to markets. But what about efficiency? Are these cap-weighted products mean variance efficient in the sense of Markowitz? If we recall economic theory, the CAPM, top-end separation theory, it says, yes, it is efficient, and not only that, the market portfolio is the only efficient, is the only portfolio of risky assets that anyone would ever need to hold. So quite a compelling case for passive management. But how real is that? So is the market portfolio really mean variance efficient in the sense of Markowitz? And who better to ask than Markowitz himself? And I don't want to give a lecture on economic theory at all. I just want to point towards this paper of Markowitz from 2005, because I think it didn't get the attention that it deserves. And it brilliantly dismisses some of the CAPM assumptions and conclusions. So the first thing is Markowitz states that one has to distinguish between the statement that the market is efficient and the statement that the portfolio is an efficient portfolio. And he explains that by stating the assumptions that are underlying the CAPM. And those are, there are no transaction costs or illiquidities. All investors hold mean variance efficient portfolios. And all investors hold the same correct belief about mean variances and covariances. So these are very strong assumptions. And I would say you could stop here. But Markowitz doesn't even discuss the validity. He just says if those are true, then this implies that markets are strong form efficient in the taxonomy of Fanon. However, this does not imply that the market portfolio is a mean variance efficient portfolio. For that to hold, there is a fourth assumption needed, which is that all investors can lend and borrow all they want at a risk-free rate. Or there is another formulation that everybody can short sell as much as they want. Only if this fourth condition is met, you can conclude that the market portfolio is mean variance efficient, and in equilibrium, expected return of each security depends only on its market beta. The reverse logic to say that empirically this connection between expected return and market beta also doesn't hold, also doesn't prove that the market is not efficient. Everything hinges on this fourth assumption. And so with respect to the CAPM, Markowitz says, it is like studying the motion of objects on Earth under the assumption that Earth has no air. Not that you shouldn't do it. And he closes, my own conclusion, it is time to move on. And indeed, I would say, yeah, let's move on. But now, if you accept that a market portfolio is not an efficient portfolio, then you have another problem. In this case, shouldn't it be easy for active strategies to outperform passive strategies? And so, why is it that so many studies find that active managers, on average, underperform? And here are some data from Morningstar that show the proportion of active managers that outperform in green versus those that underperform in red over 1 year up to 20 years on the right. And I think this is a really depressing picture. These green bars are pretty small. And as a proponent of active management, this is really just reality slapping you in the face. So why is that so? And I mean, there are many explanations to it, but I think an important or a good first step is to acknowledge that active comes in various forms. And there have been several studies trying to put some taxonomy to classify active in different groups. And one paper that I want to mention proposed 4 groups, and they find that 1/3 of all active strategy actually belong to the group which is particularly problematic. And he called it closet indexers. So those are active strategies which are actually very close to a passive index in terms of active share or tracking error. But they still charge active fees. So they're doomed to underperform. Another more recent article from AQR just reminds us that we should always distinguish active into classical discretionary strategies and the systematic quant-based approaches. And this is a distinction that I really think makes sense. So I would like to follow in this direction, and I try to sketch some attributes to characterize these 2 types of active strategies. So in a traditional discretionary active world, you have an investment process which is mainly driven by human judgment. You have a group of portfolio manager and analysts, which usually cover a rather small group of companies. They analyze them in depth by looking at fundamentals, reading balance sheets and so on. And sometimes they engage with the company, talk to the management, even visit them. And the result is a small portfolio of high conviction stocks here. And because there is a lot of human labor involved and traveling, everything comes at high cost. Then on the other end of the spectrum, the passive strategies, you're not limited in the number of stocks, of course. There's usually a much broader investment base. Everything is rule-based, automated, and therefore low cost. Now these active systematic strategies come somewhere in between. Usually they are also based on fundamental values, but because things are digitalized, you're not restricted to a certain set of stocks. Basically, you're unlimited in your stock universe. On the other side, the process is rule-based and transparent, and therefore also usually comes with lower cost. Additionally, added 3 points here. Systematic strategies are very often also using optimization techniques. So with that, you are not bound to do things sequentially, like in traditional active. You can have different, sometimes conflicting goals, which you all put into one objective function that you optimize, and you can integrate risk considerations into the construction process instead of doing an overlay. And what you obtain is usually a portfolio where you're more diversified among your intended bets, while at the same time being able to control for residual effects, like non-intended factor exposures or something. And of course, systematic strategies are nothing new. They root in the whole factor literature, and there are many products on the market. But I would say it's fair to put them in somewhere in this active-passive debate in between. And now with the next chapter, I would like to move beyond active and passive and talk about this certain paradigm shift. This has to do with a decoupling of the value chain, where we move from traditional vertically integrated firms, which do all or most parts of the value chain in one organization, to a more fragmented model, where you have an ecosystem of highly specialized players, which do not have to be in the same organization. And an example of such a decoupling of the value chain, there are many examples, but one example is the split between design and production, which is very common in many fields. So I just put two examples. In biotech, you have the company Moderna, which designs vaccines, and you have Lonza in Switzerland that does the manufacturing. Another, or similarly in the world of semiconductor, you have NVIDIA, which is really a design company, and you have companies like Taiwan Semiconductor Manufacturing Company, which really do the manufacturing, the production. And also in finance or in asset management, it's become more common to see that there is a split between design, which is construction of the investment strategy, and the production, which then would be just the trading, the execution, and also a bit of the monitoring. To go a bit more granular in this direction, I try to draw how such an ecosystem can look like in the context of fund management. So in the center of this ecosystem, you would have a fund sponsor, it could be a bank or an external asset manager, and all around are different roles that need to be fulfilled. For some of these roles, it is already today very common that they are not done by the same organization. For example, fund custody would not be usually done by the sponsor. But for other roles, it is still more common than not that they would be done by the sponsor. And those currently include the design of the investment strategy, as well as the trading often, and all the client-facing roles like distribution, marketing, and so on. But from an efficiency perspective, I think this is not necessarily ideal, because first, if the sponsor does all these roles by themselves, they're not able to focus on their core strength, which in many cases actually lies in the client relationship management. And second, when it comes to the portfolio design, for many institutions, even larger institutions, they do not have the infrastructure needed to create certain types of strategy. In particular, when it comes to systematic strategies, where you need a lot of data and a lot of data licenses, a lot of IT systems, and a quant team. So what you observe often is just a repackaging of third-party products with an additional layer of fees. And that's problematic not only for the regulator, but also from a client perspective, I would say. So if you look at studies which investigate a bit where demand is trending, they all point in the direction that what's needed are highly customizable, low-cost solutions. So, and as a seller of investment products, that basically means instead of having your shelf of products, you would prefer to have a service which allows you to create products very quickly. And I brought one such study here, which has been published end of last year from the CFA Research Institute, written by Ryan Gunnerman-Blay, with titled Beyond Active and Passive Investing, the Customization of Finance. And so, among other things, they write, the transition from portfolio management as a product to portfolio management as a service is more than just a slogan. We view this transition as profound and as impactful as other financial events, such as the creation of the open-end fund, the creation of the ETF, and so on. The distinction between active and passive management will begin to fade, if not become irrelevant. And the winning asset management firms from this point forward will be those that can successfully market to and engage with investors in developing low-cost customized solutions. And I have to say, I was quite happy to read that 1.5 years after we founded our company on exactly this premise. And so if we go back to this network, where do we place our company? We would be in the right upper part here, really highly focused on the design of strategies. And actually in this niche, we're even more restricted. We only focus on equity strategies. We are a developing partner of Bloomberg Lab Enterprise, also known as Quant. Maybe some of you have heard of it. This is relevant for us because it not only gives us access to a vast amount of data and infinite computing power, basically, but it allows also to redistribute derived results to our business clients. On top of that, of course, we have our proprietary libraries to compute signals, predictions, optimization, and so on. And in terms of our offering, basically, we acknowledge this reality that in the market is benchmark-centric. So our pricing is essentially a function of how far you deviate from the benchmark. So you have this space here, tracking error, and alpha potential. So if there's not much alpha potential, there's also not much cost to it. And so in the left corner, you basically have what is usually referred to as enhanced indexing products. The main goal is you want to replicate the performance of an index, maybe have a little bit of an edge with some small factor tilts, or maybe you need to exclude half of the stocks in a universe because of ESG restriction, but you still want to replicate the index. So tracking error there is maybe something between 1% and 2%. Then in the middle field, you have what we call active strategies. Those are more classical multi-factor strategies with tracking error between maybe 3% and 5%. And on the right, tracking error essentially becomes irrelevant. So those are then the more what one classically refers to as quant strategies. One example is fractional momentum, which we just recently launched with a family office. And just a word on the portfolio design process. So you have a workflow that starts here from left to right. You start with raw data, and you somehow need to pre-process and clean them. This is a total headache. It's not a sexy process that you can advertise, but it's an incredibly important process. It's an very important part, because basically here is where you can increase the signal to noise ratio of the data and you can impose economic structure. Then once you have clean data, there comes the modeling. That's all the fancy part, machine learning maybe, or some covariance estimation. You obtain signals, which you feed into an optimization, and the optimization gives you the final performance. The interaction with the client basically happens only at this last part, and it begins by us listening to the client. Maybe they already have some strategies in place, and maybe they have some investment guidelines, or they have some preference for a certain characteristic of the strategy. And so you take this information and basically construct the optimization model according to that. And as an example, this is just a recent project of a pension fund. They are invested in the MSCI World Universe. It's a volume of 500 million. And they're concerned with this issue of concentration, or idiosyncratic risk of super large companies. So they would like to have a maximum weight of 3%. Additionally, they entertain this idea of having some factor bets to profitability and quality companies, while at the same time controlling for value. And everything should be within a tracking error for not more than 2%. So you can take all these requirements, put them into an optimization. And so what we did is, into the objective function, you put tracking error, which you want to minimize. You add the exposure to profitability and growth. You add maybe a turnover penalty so that there's not too much trading going on. And everything else comes into constraints. So you limit the maximum weight of each position. We did that 2.7, that there is some floating. You limit the exposure of your sector and country and other factor exposures to those of the benchmark, because you have no view on them. And then also here in this case, we had to replicate their ESG policy. Everything is done on a quarterly rebalancing. So quarterly we would send a model portfolio, which they implement. And the cost for that would be, from QuantArea, 4 basis points for this model portfolio, plus implementation of 2 basis points by a global investment manager. So total, the cost would be for his, I would say, semi-active, customized global equity strategy with implementation at 6 basis points. And for completeness, I brought some backtests, but I don't want to show backtests because everybody knows that backtests always look good. So rather just a word of caution about backtesting. Maybe I've seen this quote before. If you torture the data long enough, it will confess to anything. And that's definitely true. So you can make any backtest look good. But at the same time, we heavily rely on backtests. The client want to see backtests. So somehow you need to make sure that the quality of the backtest is somehow accessible. And so we spent quite some time building a framework where we basically forced to highlight all the methodological choices. So call them design choices. And the picture on the right is not a neural network. It's just basically a visualization of the combinatorics of all these design choices. And so instead of doing one backtest, you would do basically all combinations. You show the different effects, and you make sure that the choices which are economically founded, you don't tamper with them. You don't tune them. Even if the backtest would look better, you make sure those stay the same, and you have to explicitly state which are the parameters that are data-driven that you want to tune. Yeah, so with that, I'm already through with these first 2 chapters, and if there's more time, I'll just quickly note a couple of devils in the details when it comes to factor strategies. So those have to do with this first step, this pre-processing part that I mentioned. And I listed a couple of examples. And these things are not difficult, but they are very impactful. And so when you create a factor strategy, you work with fundamental data. And the first thing is you have to make sure, or you have to acknowledge that these fundamental values do not always have the same relevance for all companies. So, I don't know, debt to equity ratio, for example, is not valid for a bank, maybe, but it is for an industrial company. So you have to account for that and somehow give a relevance to it. Another issue is that these values that you use, they have some structural differences among groups, which could be industries or regions. An example is dividend. Financial companies systematically pay higher dividends, whereas US companies systematically pay lower dividends than European countries. So if you do not adjust for these things, you would get some bias in your optimization. But you have to be careful because in the case of dividend in the US, the highest paying dividends are all in the US. So if you maximize something, you would still get all US companies. So you need to find ways how to level these things. Another issue is with ratios. Many of these fundamental values are ratios. And with ratios, you know that if one of the two numbers is negative, the interpretation changes. And sometimes it doesn't make sense to use them at all. Actually, you can say if the negative number is in the denominator, don't use it. You use the reciprocal and with some adjustments. And the last point here is often what you do is you create composite scores, but that means you aggregate them. But to aggregate them, again, you have to make sure they are on the same level. And the standard in the industry, which all the big player is doing in their methodology papers, MSCI and so on, they are creating Z-score, which they average. It's always a weighted average. I think this is not a good approach because Z-scores, they're not Gaussian. They don't have the same distribution. They can actually have very different distribution depending on the basic data. And just averaging them, first of all, you often have NAs, and then ignoring the NAs also creates a bias. And so if you would just take an equal weight, it doesn't mean that your strategy will be equally exposed to these factors or to these scores that you are using. And just to visualize an example, here are Z-scores of 4 different factor styles, which you would just average. And so this is to create this example, really specifically followed the methodology of MSCI. And there is also a thing that very often, to ensure that these Z-scores are between -3 and 3, people clip, and then the mean is not 0 anymore. So you have to be really careful with these things. But so much already about the details. So to summarize, I have 4 points. The first one is passive investing remains the dominant force in the industry, driven by a benchmark-oriented mindset where minimizing tracking error is key. That is particularly in the institutional world. Systematic strategies combine both elements of active and passive, offering a bit of the best of 2 worlds, I would say. Third, there is a clear shift underway, moving from vertically integrated firms to more modular system ecosystems of specialists. And this is a transformation which is fueled by technological innovation. And ultimately, just as the authors of the CFA study, we believe that the winning approach will be systematic strategies that are highly customizable, yet scalable and efficient, and as convenient and as cost-effective as traditional passive products. Thank you.
Thank you, Cyril. Questions? Please.
Question about details. Which optimizer do you use? The sharp like Axiom, or did you build it yourself?
No. We use Gurobi.
Sorry?
Gurobi. Yeah, it's a commercial solver. Was initially a spin-off of, not spin-off, but people from CPlex or from IBM build that. It's a very powerful machine. You know.
So it's a convex optimizer.
It solves mixed integer problems. Yeah, it solves convex but mixed integer problems. Yes.
So the problem is, for a second question, what's your experience, opinion on the market optimization?
On dynamic optimization,
Yeah, including the market impact.
on market impact.
So when you optimize, take market impact into account to plan the results, what's your opinion? Do you use it?
The thing is, in almost everything we do, we have very liquid stocks. So market impact is very often neglectable. Maybe in the Swiss market this is different. And so what we do is we don't model the market impact directly. We have a penalty on transaction cost. But what we do is just we have an adaptive mechanism that sets the maximum weight of each stock depending on the liquidity. So it's a more indirect approach.
No, I was always had the thought that the active managers are trying to create the investment performance where the passive benchmarks don't even cut the grade. They're not even alternatives. They're not valid alternatives because the passive index is, if I calculate what I call the highest level of stress you can give it so that they remain acceptable, they don't go past 0.15, 0.16. They're pretty low in the level of surety they attain. And if you want to get high risk-adjusted performance, you want to look at performance measures whereby you're comfortable at arbitrary exit points. And the passive guys don't care about that because they're just taking some long benchmark and comparing it. So, we're willing to give up mean return for creditable dynamic performance. And so if you then say you didn't make the mean that the passive guy made, well, I didn't make that mean because I didn't want to put my foot in there. The risk over there was just not acceptable to me. So I find the judgment of active strategies on the basis of whether they match the passive benchmark is crazy. Because the people that want to do and put their money in the active things is because they don't want to touch the benchmark.
Yeah, so it's good point. Doesn't even make sense to have these benchmarks. Yeah, fair point. But I think it's yeah.
So with respect to the old definition that I have in mind of active management between you make money either hiring analysts and doing stock picking or doing market timing. It seems to me that your project is you keep out stock picking, even though the systematic impact would actually imply that you are searching for the stocks that are more sensitive to some change in the relevant risk factor. So, is in which sense your definition of systematic trading is different from the traditional market timing taken from macro analysis more than the analysis of the stock?
Well, in some sense, it is not different. It's basically a systematization, an automatization of what analysts would just, what they do normally. But you just tell an algorithm to do it. But the thing is, it stops there. It's really rule based. There is no human judgment or overruling them at the end.
So the passive inflows actually more money that are coming to this area more from the private sources that can together and create the volume. But from the institutional side, they are more like active skewed, right?
Yes.
I think this is because also of historical, they have the capacities, they have some buyers, you can say they have some captive asset managers in-house, so they have to justify that. I mean, just to put it in simplistically. What did you notice, I mean, in your experience from the institutional side? I still let the private side because it's too fragmented, it's a little bit more complicated. Is there any, how to call it, do they see value in fragmenting their value chain and giving pieces of this process? I mean, portfolio, I don't know, strategic asset allocation, the manager selection process and stuff like that in hand of third parties that still like create that value for less money that's being internally produced? And what lessons learned did you see? What you experienced there?
Yeah, we have very different reactions. I mean, the clients that we have, they are obviously they are happy with this transition. They are now able to do things that they were not able, or they expand their set of products. And usually it's also sometimes they have third-party products. Now they can create the products basically under their label, and it's cheaper. So from that perspective, they're happy. But there are also many, really, the traditional active managers, they wouldn't shift. If you have this, if you are very focused on a certain sub-industry and you have this story that you analyzed and you engage with the companies, it's not something that you can automate.
I just wanted to add something. I mean, I agree with George about passive and active. I mean, actually, it's correct. I think it might be slightly misleading. The reason for this is that in the US market, I think it's mainly driven by an advisory model, where the advisor, he has to justify his fees because he owns fees as well. The trend there basically has been to just say, all the active managers, they underperform, so we sell them and we switch to passive. But the problem is we switch to passive, but they become even a lot more active. Because if you look at these passive flows, they are in and out, and it's almost a momentum market. So all these advisors, what they do is they eliminate the active ones, which you could say, they're fundamentally driven, and you could say, okay, they underperformed. The fees were on basis points, they underperformed down to 10 basis points. Calls for the active. But now these advisors, I would guess they are by about 200 basis points because they are so active, and all the fees that they save on the active manager, they just evaporate into chasing trends. And you see this, there was again a number, now there are even more ETFs than listed stocks. And this was not phenomenon with the mutual one as well. I mean, this is a huge marketing. So I think this chart actually is correct, but from the behavior is the complete opposite, because these investors, when they buy the S&P ETF, they don't hold it. They buy it because they think, I don't know, yields go down, earnings go up, whatever. They have some market views, and it's not in the past.
Yeah, I mean, it's a good point. Thank you. I mean, in the CFA study that I showed, they also do an analysis of how many active and passive, and they do it globally. And you see, so it's not only a thing in the US, it's everywhere. But the data only goes until 21. That's why I use the US. But your point is right that in the US specifically, I think you have these advisory models much more. And it's funny. I had a slide which I took out, which will talk about some misconception, and I found one statement of a company that said, "We are invested passive, and we constantly adjust our position to use inefficiencies in the market. So it's pretty much what we're saying.